I've been riding the crypto roller coaster since 2017, and I've made some nice gains, but nothing life-changing yet. But this recent bear market has been a blessing in disguise because it has given me the time to rethink my approach, study those who made it, and create my own master plan to get rich during the next bull market. I call it the HALDS method, and it's my 5-step plan to maximize our gains. I hope that by sharing it with you, I can save you time, help you avoid my past mistakes, so we can all reach our financial goals together. Now, before we get to the H part of the HALDS method, we gotta address the elephant in the room, aka why I'm assuming that there will even be a bull market in 2024. Well, I'm pretty confident that we'll have one for 3 main reasons. First, I think the macroeconomic environment will be significantly better in 2024. The Federal Reserve pretty much caused this bear market by raising interest rates like a madman. They did it to tame inflation, of course, but that also put a lot of stress on the broader financial system. Like all those banks that failed recently? Yep, you can thank the Fed for that. But here's the thing. I don't think they can continue on their current path. They'll be forced to stop sooner rather than later because they may cause another global financial crisis if they go any further. So when they inevitably ease up, that is when our bull market kicks off once again. It's not only that though, we also have the Bitcoin halving coming in April of 2024, and that's going to lead to significant price increases for Bitcoin. I'm not going to defend my thesis as to why the halving leads to bull runs because I already covered that in a previous video. But just know that if Bitcoin does rise again due to the halving, then it'll kick off a broader crypto bull market as a rising tide lifts all ships. Now, my third reason for 2024 bull market is that all the infrastructure in the crypto world will finally be ready for mainstream adoption. Like we got a bunch of layer 2 networks popping up, and those will give us the low fees and fast speeds that us end users crave. Also, DeFi projects are getting to the point where they can handle the load that centralized platforms used to handle. And speaking of those centralized platforms, the ones that survive will emerge hardened and ready to take on whatever challenges the market throws at them. So yeah, with the infrastructure ready, Bitcoin's halving on the horizon, and a Fed pivot coming closer every day, I'm super confident that the bulls will be back next year. That's why we need a careful strategy like my HALDS method to fully take advantage of it. So let's start with the H in HALDS, which stands for Hold Blue Chip Coins. Basically, with 50% of your portfolio, you should buy and hold blue chip coins like Bitcoin and Ether. Now, why do we want to do that? Well, because Bitcoin is likely headed to 6 figures and ETH 5 figures during this next bull market. So they have decent upside, but compared to altcoins, they're also more proven, so you can hold them longer term and not have to worry that they'll go to zero. That's why these lower risk assets must be in our overall portfolio because they do give us solid gains even though it's not 100x per se. Also, in terms of how to execute this part of the strategy, just take 1/3 of that 50% allocation and buy Bitcoin and ETH lump sum if you don't have any right now. Then with the rest, just dollar cost average weekly using some bot or service so you don't have to rely on your own personal discipline to make that happen. Now the next question is, do we just hold these forever? Well, you could, but we can also be a little smarter than that and use some data to our advantage because we're trying to get rich this upcoming bull market, right? Not the next one. So you can use some metrics like the Mayer multiple to create a simple rule for when to dollar cost average and when to start taking profits. Basically, the Mayer multiple is the number you get when you divide Bitcoin's current price by its 200-day moving average price. Historically, when that's gone above 2.4, it means that the price is getting overextended, and that's been a good time to sell. And we can adjust that number even more if we take into consideration the fact that there's less volatility in Bitcoin's cycles as it matures. So we could decide to use 2.0 as a threshold instead, and dollar cost average as long as the Mayer multiple is below 2.0, and start taking profit when it gets above 2.0. Now, as for what to do with those profits, well, we can use that to buy altcoins in the S part of our HALDS method, which I'll get to in a bit. But first, the A part of the method, which stands for airdrops. Basically, we want to farm as many airdrops as possible because that's free money that we can deploy elsewhere. Also, we've seen multiple airdrops over the years give people 4 and even 5 figures with the crypto for just trying out the product for a bit. So this is a crucial part of our strategy that everyone should do. And for some great airdrops to farm, you can watch my airdrops video that we recently launched. But the main thing you gotta understand here is what to do with your airdrop tokens. Like, should you sell immediately or hold them for more gains? There was actually a research study that found that selling your airdrop tokens immediately made you more money than holding on average. But that study was a bit flawed because it was conducted during the bear market, and our strategy is for bull market times, right? That's why I like this strategy more. And that's to sell 40 to 60% of your airdrop tokens immediately and then keep the rest as a moon bag. You should sell closer to 60% if the market is feeling overall bearish and closer to 40% if the market is feeling overall bullish. But then there's the question of what to do with our remaining moon bag, right? Because we certainly don't want to hold it forever like through a bear market. Well, here's one way to approach it. And it will require you to do some simple math. Basically, depending on the project, estimate a market cap for it that you think it can realistically achieve during the absolute peak of the bull market. You can anchor it to some similar projects in its niche, as well as the biggest projects out there like Bitcoin and Ether. And that's to make sure that your estimate is reasonable. Then set up a bunch of levels from the current price up to that peak market cap price and determine a percentage of your moon bag to sell at each level. Just note that by the time the price gets to the peak, you should have sold 90% or more of your moon bag. That way you won't be stuck with trash when the market inevitably turns. All right, we got H and A. Now it's time for the L part of our method, and that stands for leverage. Now, before you get mad at me and leave nasty comments, just know that I'm only allocating 10% of our capital for this part. It's really not that much because I know leverage is risky and could get us liquidated. But this is only a small percentage for degen longing during the bull market. Also, if we consider Bitcoin's price action in previous bull markets, we'll see that the average pullbacks or corrections were around 22%, and the biggest pullback was 31%, which means even if we went long with 3x leverage at that regional top, we would still not get liquidated. Anyways, I'm not going to teach you how to margin trade in this video, but I will recommend that you only open leverage longs when there's a bullish trend that's confirmed by the moving averages. Also, I'd recommend entering your first position only after the first 15 to 20% correction that we encounter. And lastly, I'd recommend no more than 2 to 3x leverage and to stick with Bitcoin or Ether, as those are not as easy to manipulate. All right, we're getting close. Onto the D part of the system, which stands for dry powder. Basically, you should keep 20% of your portfolio as dry powder for emergencies and unforeseen circumstances. This may actually be the most important part of the HALDS system because boy, were there so many times in the past where I wish I had some more capital left to deploy. That's why we keep dry powders, folks, for extraordinary buy the dip opportunities, or in the case that some new gem appears that we want to buy, or if the accumulation phase lasts longer than expected. So yeah, there's plenty of reasons to keep dry powder around even during a bull market. And trust me, you're gonna be glad that you did because it's human nature to get too bullish and over deploy prematurely. Now finally, it's time for the altcoins and 100x gems part of our strategy, the S part of the method, and that stands for swing trade altcoin gems. Basically, we'll allocate 20% of our capital to make some concentrated bets on altcoins. Because altcoins are smaller, so they can give us the massive 10x or even 100x gains that we're looking for. But there is an art to this, so don't just go throwing darts on the wall to see what sticks. For example, I would limit the altcoins that you buy to around 5 to 10 instead of spreading yourself way too thin with like over 20 coins. Ideally, you would do thorough fundamental analysis to decide which coins to buy here. I won't teach you how to do that in this video, but basically you should look at things like valuation, the team behind the project, and their competitive advantage. You could also ignore fundamental analysis completely for things like meme coins, which I think is fine as long as you have a well thought out thesis for it and are not just falling for FOMO. So yeah, once you pick your coins, start accumulating them by using dollar cost averaging. It's super important though to stop dollar cost averaging and start taking profits once you see some big moves with these altcoins, say around 3 to 5x gains. You can then rotate these profits into other positions or buy new coins with them. You can also keep a moon bag, but definitely sell that once you detect some market weakness, because you definitely don't want to hold that for too long and lose all your precious gains. So that's the HALDS method, folks. It's easy to understand, but hard to properly execute. So definitely watch this video multiple times, take notes, and set reminders for yourself. But also this is my plan, and it's not perfect by any stretch. So please feel free to adjust it, change things, and make your own plan as you see fit. The most important thing though is to be intentional about it. Write down your plan and faithfully execute it, or else you may fall for the most common mistakes and have to wait yet another cycle before hitting your financial goals.